if you're 25 and you have to wait until you're 59 and that grows over those years, you don't have to pay the tax. As we all know, coming up on March 15th, the Ides of March, known from Julius Caesar, but it's also the time back then where all debts were settled. And today on Money in the Bank with Frank, so we're going to talk taxes. We're coming up on the corporate tax filing deadline and what you need to do to get ready for tax time. We're going to focus on corporations today. This is my kit from my attorney, J. Mark Lewis and Associates. Not a sponsor, but if he wants to be, feel free to give me a call and send me some money. And he's got a kit here that everyone should fill out that's a client of his so that they at least have the basics and the bare bones of what they're going to discuss and do on their taxes. And there's only two people in the world that love tax time, and that's accountants and the government, because the government's going to get their money, and the accountants who effectively have their normalized income 4 times a year, March 15th, April 15th, September 15th, and October 15th. Those are the tax filing deadlines, the corporate and individual tax filing deadlines. And since they do that work 4 times a year, they get checks 4 times a year. So they want to be efficient with their time. And we need to be efficient with ours and with our savings. And the best way to do that is to get all your ducks in a row. Earlier today, and I hear it a lot, I hear from people that are fairly young that say, I don't have to do my taxes. I don't want to do my taxes. I don't know why anyone would not want to do their taxes in this day and age. Anybody that files or that makes money working for a W-2 employer, the W-2 employer is filing notices to the IRS. They already know how much you're making, and they're going to come after you with all this wonderful electronics to say, yo, and if you don't, and if you are owed money back, why wouldn't you want that? And there's a good chance that if you're not making, if you're just starting out, you're probably going to get everything that you paid into it back. The rates are very favorable to people just starting out, depending on your income. But for those of us who are throughout the spectrum, there are many little things that you can do to minimize your taxation. On the corporate side, you want to make sure that you max out your retirement contributions. If you're a small business owner with very few employees, you could set up something as simple as a corporate retirement plan that caters to small business owners. They are very favorable and they allow you to put away a tremendous amount of money up front. And then as an employee, if you do not have a retirement plan, or if you are in this gig economy and you are an independent contractor, there are many of retirement plans that you can do as well. Now, why do I stress retirement plans? I stress them because retirement plans are a great way, a great opportunity to pay yourself without having to pay the IRS. So let's say that you make $25,000 a year and you put in your $5,000 to your traditional IRA. Well, you get to take that $5,000 right off of the top. So instead of $25,000 you're paying taxes on, you're paying $20,000 paying taxes on $20,000. That $5,000 will grow, hopefully, under the right, if you put it into equities and or whatever, talk to your financial advisor. Hopefully that will grow over time. And if you're 25 and you have to wait until you're 59 and that grows over those years, you don't have to pay the tax on the growth until you start to pull it out. And the thought is that by then you should be in a lower tax bracket because you're no longer earning. When you retire, you're not making that income. So now you pull the money out and hopefully you're in a lower tax bracket. Doesn't always happen that way, but prepare. Save your money, save your taxes, because you never know when bad times are going to hit. So what do we have here? What do we have to work with? We've got a couple of different types of retirement plans. As an employer, you've got 401k, which is the standard, and that's usually done for corporations that have been in business, not really worried about going out of business, are willing to do a budget and willing to commit to setting up a retirement plan for your employees. 401ks are very common. There's a variety of companies that are willing to work with small business owners on small business retirement plans. You've got your payroll providers from ADP, QuickBooks, Intuit, to companies like Charles Schwab, Fidelity. They all offer these types of programs. You just have to get with your attorney, accountant, financial advisor, and try to find one that works best for you. That's a 401k. Then you've got your SEP IRAs. Much more flexible. You can sock away 10 times the traditional limit of regular IRA or Roth IRA. And then you have, certain different things that you can do individually, like the Roth IRA, which allows you to put money into a retirement plan that will grow. You're not getting the deduction that you would on a traditional IRA, but it grows tax-free. Yeah, you heard that right. When you pull it out, there will be no taxes on any of the gains, as long as you do it within the rules, over 59.5 once you get to retirement age. Before that, there are some different provisions that allow you to do some fun stuff with it as well. But again, that's not what we're talking about. Not on topic for today. Second thing that you have is a traditional IRA. This is the one that always started out $2,000 a year years ago. Now it's, the limits for 2022 on the Roth IRA are single filers, adjusted gross income under $129,000. You can contribute $7,000 if you're over 50 and $6,000 if you are under. So again, you get to take $6,000 off of your income after taxes. Like if you're a W-2 employee and you put $6,000 away to a traditional IRA, if you put the $6,000 in, you get to deduct $6,000 as if it had come straight off the top. But again, that's a traditional IRA. When you pull the money out, you're going to have to pay taxes on anything that you pull out at your then current tax bracket. And that's what we have for the IRAs today. Now, I need to come up with some more stuff to talk about. Thanks for watching. If you like this content, you can find me on Money in the Bank with Frank on all of your favorite podcast platforms, on Facebook, on LinkedIn, on our YouTube channel. Look forward to bringing you more content like this in the future. Thanks.